My accounting analyst subscribers and viewers, welcome back to the channel. Today we will continue our journey of looking at the financial statements by looking at how to use accounting and financial ratios to analyze and interpret the financial statements. So without further ado, let's get into it. Financial ratios are analytical tools that use data from financial statements to assess a company's performance and financial position over time. Financial ratios provide a standardized way to compare companies of different sizes, industries, and across different time periods. Now, financial ratios are important for several reasons. 1. They facilitate comparison between companies or industries. 2. They simplify complex financial data. 3. They can be used to identify trends over time. 4. They highlight areas of strength or weaknesses in a company's operations. 5. They allow for a quick assessment of a company's financial position. 6. They aid in decision making for investors, creditors, management, and other stakeholders. There are several financial ratio categories, and we look at each of these. The categories are 1. Liquidity, 2. Profitability, 3. Leverage, 4. Efficiency, and 5. Market value ratios. Those are the 5 categories, and let's look at each of them in a little more detail. Liquidity ratios. So liquidity ratios measure a company's ability to meet its short-term obligations. That is, whether it is able to pay for its current operating expenses and service its debt, if it has any. Some key liquidity ratios include the current ratio, the quick ratio or acid test ratio, and also the cash ratio. Let's take a deeper dive into the liquidity ratios. The formula for a current ratio is current assets over current liabilities, and this ratio measures the amount the company has in current assets for every $1 in current liabilities. A good current ratio should be above 1. The quick ratio or acid test ratio. This ratio is current assets minus inventory over current liabilities. The quick ratio measures a company's ability to meet short-term obligations without relying on sales of inventory. And like the current ratio, an ideal quick ratio should be above 1. The quick ratio is a more conservative measure than the current ratio. A company could have a quick ratio below 1 and still be able to meet its short-term obligations, but ideally you want to have that above 1. The quick ratio varies by industry, and companies in some industries will be able to meet their short-term obligations despite a lower than average quick ratio. Next up is the cash ratio. The cash ratio is cash and cash equivalents divided by current liabilities, and this is even more conservative than the quick ratio. In fact, it's the most conservative of the liquidity ratios, and it shows a company's ability to pay off short-term debts immediately. That is, without having to sell any other assets like inventory or to collect its receivables. An ideal quick ratio should be between 0.5 to 1. The cash ratio, like other ratios, varies by industry, and some industries will still be able to meet their short-term obligations despite a lower than average quick ratio. So a little judgment is needed in assessing the liquidity ratio. Another liquidity ratio is the cash conversion cycle. This measures how long it takes for a company to convert inventory back into cash, and it's calculated as days inventory outstanding plus days sales outstanding minus days payables outstanding. This is basically taking the number of days a company takes to sell its inventories plus the number of days it takes to collect its receivables and minus the number of days it takes to pay its suppliers. The net of all that gives you how long the company takes to convert inventories into cash, and shorter is always better. Next, we look at profitability ratios. Profitability ratios are used to assess a company's ability to generate profits relative to sales, assets, and equity. Key profitability ratios include your gross profit margin, net profit margin, return on assets, return on equity, and EBITDA margin. So let's take a closer look at the profitability ratios. So the gross profit margin is calculated as revenue minus cost of goods sold divided by revenue times 100. And the gross profit margin measures the percentage of revenue that exceeds the cost of goods sold. A higher margin indicates better efficiency in production and pricing. Next, net profit margin. The net profit margin is net income over revenue times 100. And the net profit margin shows how much profit is generated from each dollar of sales. Return on assets or ROA. Return on assets is net income over average total assets times 100. And this ratio measures how efficiently a company uses its assets to generate profits. Return on equity, ROE, and the return on equity is calculated as net income over average shareholders' equity times 100. The ROE indicates how effectively management is using shareholders' investments. Another ratio is EBITDA margin. EBITDA margin is equal to EBITDA over revenue times 100. And what is EBITDA? EBITDA is earnings before interest, taxes, depreciation, and amortization. EBITDA basically strips out non-operating expenses such as interest and taxes and non-cash expenses such as depreciation and amortization, and is a better reflection of how a company's operations are performing. So EBITDA is basically an operating metric as opposed to non-operating. For profitability ratios, higher is better. You want these ratios to be as high as possible. The higher they are, the better your company is performing. Third type of ratios is leverage or solvency ratios. Leverage ratios are used to evaluate a company's debt levels and ability to meet its financial obligations. Some key leverage ratios include debt to equity, interest coverage, and debt to EBITDA ratio. Let's dig a little deeper into the leverage ratios. Debt to equity. So debt to equity is total liabilities divided by shareholders' equity. A lower debt to equity ratio means the company has less financial risk. Interest coverage ratio. The interest coverage ratio is equal to EBIT over interest expense. The EBIT part of it is earnings before interest and taxes. And the interest coverage ratio shows whether a company has enough earnings to pay interest on its outstanding debt. A higher interest coverage ratio is better, as it suggests that the company has more cushion to cover its interest expenses. Next ratio is debt to EBITDA ratio. Debt to EBITDA is equal to total debt over EBITDA, and we earlier defined what EBITDA is. The EBITDA ratio indicates how many years it would take a company to pay off all debt if EBITDA is used entirely for debt repayment, which in reality is not realistic, but this is just a hypothetical situation, and a lower EBITDA ratio is better. Next is efficiency ratios. Efficiency ratios measure how well a company uses its assets and manages its liabilities. The higher these ratios are, the more efficient a company is in using its assets to generate profits. Some key efficiency ratios include inventory turnover, accounts receivable turnover, and asset turnover. Let's dig a little deeper into efficiency ratios. First one is inventory turnover. Inventory turnover is cost of goods sold over average inventory. Higher inventory turnover ratios indicate more efficient inventory management. Accounts receivable turnover. Accounts receivable turnover equals revenue over average accounts receivable. And this ratio measures how quickly a company collects payment from customers. Higher accounts receivable turnover indicates faster collection of receivables. Next ratio is asset turnover. Asset turnover ratio equals revenue over average total assets. Asset turnover indicates how efficiently a company uses its assets to generate revenue and profits. A higher ratio indicates more efficient use of assets to generate revenue. The last set of ratios we will look at are market value ratios. Market value ratios assess a company's stock price relative to financial metrics. Some key market value ratios include price to earnings or PE ratio, price to book or PB ratio, and dividend yield. All of these ratios won't work for all companies. For example, price to earnings and price to book typically will only work for public companies that have a stock price. Private companies typically don't have a price, so these ratios cannot be computed. Let's dive a little deeper into market value ratios. So the price to earnings ratio is market price per share divided by earnings per share. The PE ratio indicates how much investors are willing to pay for each dollar of earnings. The PE ratio is one of the most popular ratios used among investors to gauge how a company's market price is performing relative to its share price. A higher PE ratio indicates that investors are willing to pay a higher price per dollar of earnings for a company's stock, and this indicates that investors have good prospects about the company's future. So the higher the ratio is, the better investors feel about a company's future prospects and ultimately increasing its share price. Price to book ratio is market price over the book value per share. And this is similar to the PE ratio, except it uses book value per share instead of earnings per share. Book value is computed as total assets minus intangible assets minus total liabilities, and it shows the historical cost of a company's physical assets. Thus, we subtract all intangible or non-physical assets to arrive at book value. The price to book ratio is measuring how much investors are willing to pay for each dollar of the company's physical assets. And as I mentioned, intangible assets are excluded from the calculation because they are not physical assets. And the last market value ratio we look at is dividend yield, which is annual dividends per share divided by market price per share. The dividend yield shows the return on investment for dividend paying stocks. And as you know, not all stocks pay dividends. Okay, so those are the major categories of financial ratios. Now we'll take a look at how to interpret those ratios. Here are some steps you can take to interpret financial ratios. First, compare ratios to industry benchmarks. If ratios are significantly higher or lower than industry norms, you should investigate to see if there is an issue with the company's operations. Second, analyze trends in ratios over time. 3. Consider the company's business model and strategy when analyzing ratios. 4. Use multiple ratios for a comprehensive view. And 5. Be aware of potential limitations or manipulations. Let's look at some limitations of financial ratios. Financial ratios do not come in a foolproof case. They should be analyzed on a combined basis and not in isolation. One ratio by itself will not tell the story of what is happening in a business. Here are some things to consider about ratios. 1. Ratios are based on historical data and may not accurately predict future performance. 2. Different industries may have different ranges for ratios. 3. Ratios can be affected by accounting methods or one-time events, so be on the lookout for these. 4. Ratios may not capture intangible assets or market position. And 5. Ratios should be used in conjunction with other analytical methods. We'll now look at an example of how we can apply financial ratios in a real-world situation. ABC company has current assets of $1 million, current liabilities of $800,000, inventory of $175,000, revenue $1.5 million, net income $250,000, total assets $1.25 million, and shareholders' equity $1 million. Okay, we'll now calculate and interpret some ratios. Starting with the current ratio. So the current ratio is $1 million over 800,000 equal 1.25. This means the company has $1.25 in current assets for every $1 in current liabilities, suggesting that it has good short-term liquidity. 2. The quick ratio, which is current assets minus inventories over current liabilities, is $1 million minus 175,000 over 800,000 equal 1.03. This means that even without relying on inventories, the company can cover its short-term liabilities. The net profit margin, which is net income over revenue, is $250,000 over $1.5 million equal 0.17 or 17%. What does this mean? This means that the company generates 17 cents of profit for every dollar of revenue. Return on assets is $250,000 in net income over $1.25 million in assets, which is equal to 0.2 or 20%. This means the company generates 20 cents of profit for every dollar of assets. Return on equity, which is net income over equity, is $250,000 over $1 million or 0.25 or 25%. This means that the company generates 25 cents of profit for every dollar of shareholders' equity. Again, a positive number is a good number. Those are some examples of financial ratios, how to calculate them and how to interpret them in a real-world situation. Financial ratios are powerful tools for analyzing a company's financial health and performance. However, be careful, they should be used as part of a broader analysis that includes understanding the company's business model, industry trends, and conditions. They can't be used in isolation by themselves. When used correctly, ratios can provide valuable insight for investors, creditors, and management, and allow them to make better investment and management decisions. Financial ratios should be in every business's toolbox. Learning to use them will put you ahead of the financial game. And that's a wrap for this video. Please share the video with your friends and colleagues, and do remember to like, comment, share, and subscribe. And let us know which topics you would like to see us cover in the future. Until next time, take care of yourself.